Happy Friday. It is February 13th, 2026. And if you are watching the markets this morning, you probably saw the headlines about Coinbase.
Oh, yeah.
They dropped their Q4 2025 earnings report. And, well, to put it mildly, the numbers look like a bit of a crime scene.
A crime scene is a good way to put it. I mean, it definitely wasn't the victory lap people were maybe expecting. A net loss of $667 million. A revenue miss.
Yeah.
If you're just an algorithm scraping headlines, you probably sold the stock immediately.
Right. And that's exactly what I want to get into, because this is a company that is, kind of the proxy for the entire crypto economy.
It is.
And on paper, they just lost over $500 million in 3 months. But, and this is a big but, they also just announced they're buying back billions of dollars of their own stock.
That's the classic contradiction, right?
Yeah.
Usually when a company is bleeding cash, they hoard every penny. They don't go out and spend $2 billion buying their own shares.
Exactly. So that's our mission for this deep dive. We need to figure out how a company can lose that much money on paper while at the same time acting like they're totally flush with cash. We need to look under the hood.
And once you do, and we've gone through the full transcript and the shareholder letter, the story just changes completely.
Yeah.
It stops being a story about a bad quarter, and it starts being a story about a massive strategic pivot.
And this is that everything exchange concept we've been hearing whispers about for a while.
That's the one, but it goes even further. I mean, there's a section in this report about AI agents and crypto wallets that, honestly, it sounds like science fiction. But according to the data, it's happening right now.
Okay, so a lot to cover. We have the messy financials, the big strategy pivot, and apparently the robot economy.
Yep.
Let's start with the pivot. Back in mid-2025, Coinbase rolled out this vision of the everything exchange. It sounds like a great marketing slogan, but what does it actually mean in practice?
Well, it's really the unbundling and then the rebundling of your entire financial life. Think about it right now. You probably have a brokerage app for stocks, like a Robinhood or a Schwab.
Right.
You've got a separate app for your crypto, maybe a DraftKings account for some sports betting, and then, your boring old bank for everything else.
And none of them talk to each other. Moving money between them takes days. It's a pain.
Exactly. The thesis behind the everything exchange is just why? Why not have a single platform, a single app where you can trade Bitcoin, buy Apple stock, bet on the Super Bowl, and hold gold futures, all from one login?
So it's the super app strategy, but is it actually working? Because, anyone can build a feature, but getting people to use it is a totally different ballgame.
The data says it's working. I mean, their global trading volume and market share doubled year over year. But the most interesting part isn't just that people are trading more, it's what they're trading. A huge driver of the recent growth was derivatives.
Okay, let's pause there. Derivatives. That is one of those finance terms that gets thrown around, and I think a lot of people just nod along. For someone listening who might not be a day trader, what are we talking about here?
Let's keep it simple. Spot trading is when I pay you cash, you give me Bitcoin. I own the actual coin. A derivative is just a contract that's based on the future price of that Bitcoin.
Okay.
It lets traders do two main things.
Hmm.
Hedge their risk, kind of like insurance, or leverage their bets to try and make more money with less capital.
So it's for the more sophisticated crowd.
Generally, yes. But it is where all the volume is in traditional finance. And in Q4, derivatives activity hit an all-time high on Coinbase. And this was largely fueled by their acquisition of Deribit.
Right, they closed that late last year.
They did. That was the largest crypto deal ever, by the way.
Wow. And it's not just crypto derivatives, is it? I saw a note in the transcript about commodities.
Yes. And this is the part that really proves the everything exchange thesis. Brian Armstrong, the CEO, he mentioned that just last week, even while crypto prices were dipping, they saw record volume in gold and silver futures.
That is fascinating that you have people logging into what they think of as a crypto app to trade gold, which is about as old school an asset as you can get.
It proves that once the user is in the ecosystem, they'll trade whatever is available. And this month, February 2026, they are rolling out equities. We're talking about nearly 10,000 stock tickers going live.
10,000. So that's basically the entire stock market.
It is. So now you can sell your Ethereum and instantly buy NVIDIA or Tesla without, waiting 3 days for an ACH transfer to clear to your bank and then sending it to your brokerage.
And then you layer on the prediction markets. They just roll that out to 100% of customers.
Prediction markets are having a huge moment. I mean, the Super Bowl was a massive onboarding event for them.
I can see that. But is that really a sustainable business? Just betting on sports and elections?
Well, it's not just about the revenue from that one bet. It's about stickiness. Think about it.
Okay.
If you come to Coinbase to bet on the Chiefs, you have to fund your wallet. If you win, that money is now sitting inside the Coinbase ecosystem. Maybe you don't withdraw it. Maybe you see Solana's down and you buy a little bit. Or you put it in a high-yield stablecoin.
It turns a one-time transactional user into a permanent resident of the platform.
Precisely. It diversifies their revenues so they are not purely dependent on whether Bitcoin is going up or down. They're trying to decouple their business from the crypto price cycle.
Which brings us right back to the numbers. Because if the strategy is working so well and volume is doubling, why on earth did they report a GAAP net loss of $667 million? That's a scary number.
It's a very scary headline, but this is where you have to separate the operating reality from the accounting reality.
Okay, walk us through that.
So Coinbase holds a massive amount of crypto on its own corporate balance sheet. They believe in the asset class, so they hold it. Under the current accounting rules, if the market price of those assets drops during the quarter, even if they don't sell a single coin, they have to report that drop as a loss.
So it's a paper loss. It's like if I check the value of my house on Zillow and it says it went down 5%, I didn't actually lose any money unless I sell my house right then and there.
That is the perfect analogy. They took a $718 million unrealized loss on their crypto portfolio in Q4. They also did a $395 million loss on strategic investments, which includes their big stake in Circle.
The company behind the USDC stablecoin.
That's the one.
So if you strip out those paper losses, if you just look at the actual business of running the exchange, paying employees, keeping the servers on.
They're highly profitable. Elijah Haas, the CFO, she made a very specific point to highlight this. She noted this was their 12th consecutive quarter of positive adjusted EBITDA.
Adjusted EBITDA. Another one of those fun acronyms. But that's basically cash flow from operations, right?
Essentially, yes. It's a measure of, is the machine making money before we count all the accountants' weird adjustments? And operationally, the engine is humming. And the strongest signal that they know this is the buybacks.
Right. This is what jumped out at me. They have $11.3 billion in cash just sitting there. And they just bought back $1.7 billion of their own stock.
And the board just authorized another $2 billion for more buybacks. You do not do that if you're worried about butts your bills. You do that when you think the market has completely mispriced your company and you're getting a huge discount on your own stock.
It's the ultimate vote of confidence. They're basically saying, we know the headline looks bad, but please look at our bank account.
Yeah, and for any investor listening, Elijah Haas explicitly said they have fully offset the dilution from stock-based compensation for 2025. That is just music to an investor's ears.
It means your slice of the pie isn't getting smaller.
Not at all.
Okay, so we've got the everything exchange driving volume, and we have a fortress balance sheet despite the accounting noise. But I want to pivot to what I think is maybe the most transformative part of this entire report. The second killer app.
Stablecoin.
Specifically USDC. We always obsess over the volatile stuff, the meme coins, the 100x stuff. But stablecoins are just quietly becoming the rails of the new internet.
They really are. USDC's market cap hit an all-time high of around $75 billion in Q4. And for Coinbase, the revenue they get from subscriptions and services, which includes the interest income they earn on the reserves backing USDC, that's up 5.5x from its peak in 2021.
5.5 times. That is an incredible cushion. When trading volume dries up, that interest income keeps the lights on.
It does. But the real story here isn't just about interest rates. It's about utility. And this is where we get into that sci-fi territory you mentioned.
Yes, the AI agents. Brian Armstrong dropped this little nugget during the call, and my ears just perked right up. He started talking about AI agents adopting crypto wallets.
It's a fascinating glimpse into the very near future. We're building these autonomous AI agents that need to perform tasks. They need to buy API access. They need to pay for server space. They need to buy data from other bots.
And I'm guessing ChatGPT can't just walk into a Chase branch and open a checking account?
Exactly. No bank is going to give a software program a credit card. The Know Your Customer laws, -KYC, make it impossible. A robot doesn't have a driver's license. But a crypto wallet, you can spin one of those up in milliseconds with just a few lines of code.
So Armstrong's bet is that stablecoins are going to become the native currency of AI.
That is the bet. And he backed it up with data. He mentioned that Base, which is Coinbase's own Layer 2 blockchain, is hitting transaction highs that are specifically being driven by AI agents adopting these wallets.
That completely reframes the whole concept of user growth. We always talk about onboarding the next billion humans. We talk about the unbanked and emerging markets.
But the next billion users might not be biological. I mean, think about it. If you have an economy of AI agents, trading services, paying each other in fractions of a cent 247 at machine speed,
Yeah.
you need a payment rail that can handle that. The traditional banking system takes days. Crypto is instant and global.
It's the machine-to-machine economy, and Coinbase is trying to position Base as the infrastructure layer for it.
It's a brilliant move. If everything exchange is for the humans, Base is becoming the home for the bots.
Okay, let's talk a bit more about Base. You said it's a layer 2. For the listener who hears that term but doesn't quite get the mechanics, what's the relationship between Base and Ethereum?
Sure. Think of Ethereum as the main highway. It's super secure, it's decentralized, everybody uses it, but because everyone uses it, it gets congested. You get traffic jams, and the tolls, the gas fees get really expensive.
Yeah, okay, yeah.
Base is like an express lane built right on top of that highway. It processes thousands of transactions incredibly fast and for pennies, and then it bundles them all up and settles them on the main highway later for security.
And Base is now the #1 layer 2 on Ethereum.
It is. And there's been this philosophical debate in the crypto world about this. Vitalik Buterin, Ethereum's creator, he recently wrote about the danger of having too many L2s that can't talk to each other. He's worried about fragmentation.
Right. If my money is on Base and your money's on another one, can we even do business?
Exactly. Coinbase's view, which they mentioned on the call, is that we don't need hundreds of these things. We need a few high-utility chains that are easy to use, and they're monetizing Base directly through what are called sequencer fees.
Which is basically the toll you pay to use the express lane.
Yes, but they also monetize it indirectly. The more people or bots use Base, the more they use USDC. The more USDC there is, the more interest income Coinbase earns. It's a classic flywheel.
It always comes back to the flywheel. Okay, let's zoom out a bit. We're in February 2026. The mood out there is, well, it's cautious. Analysts on the call were asking about a crypto winter. Is the vibe shifting?
It was the inevitable question. An analyst from Goldman asked point blank, are we heading into another bear market? And management, they played it cool. They said, you know, we don't predict cycles. But they did drop a very interesting data point about retail investors.
What was that?
They noted that retail is currently buying the dip. In past cycles, think 2018, 2022, when prices fell, retail panicked and sold. They ran for the exits. The data now shows net buying.
That suggests the investor base is maturing. People aren't just here to gamble anymore, they're accumulating.
It does. And Coinbase's argument is that their business model is now strong enough to handle a downturn. In the past, if trading volume went to zero, so did their revenue. Now, with subscription revenue and stablecoin interest, they have a floor. They can survive a winter that would have killed them 4 years ago.
And the other big factor is the government. This feels like a completely different conversation than we were having in 2023. We're not talking about SEC lawsuits. We're talking about legislation.
It's night and day. The relationship has shifted from adversarial to cooperative. Brian Armstrong, he highlighted the Genius Act, which passed back in mid-2025.
I still love the acronyms Congress comes up with.
It's branding at its finest. But the substance really matters. The Genius Act created a framework for regulated stablecoins. And crucially, it allowed for rewards, interest, to be paid on them.
And why was that so important?
Competitiveness. Armstrong's whole argument is that if U.S. stablecoins can't pay interest, all that capital will just flow to offshore, unregulated platforms, or, even worse, to state-sponsored digital currencies from places like China. He frames it as a national security issue.
And there's more coming down the pipe, right? The Clarity Act.
Yes. Armstrong sounded very optimistic that the Clarity Act will pass in the next few months. That's the big market structure bill. It's designed to finally create a level playing field between banks and crypto.
He used the phrase ending protectionism for the incumbents.
Which is polite CEO speak for stop letting the big banks write the rules to block us. He also noted there are now 150 government agencies using Coinbase's software. They are embedded in the system.
That's a huge shift. From renegade outsider to government contractor. Okay, before we wrap, we have to mention the glitch. Because if you were trying to trade yesterday, you might have been frustrated.
We have to mention it. Yeah, on February 11th and 12th, there was a technical outage. Users couldn't buy or sell.
And honestly, the timing could not have been worse. It immediately makes people nervous.
It does. And one analyst brought up BlockFi and how they suspended withdrawals right before they collapsed. The question was pretty much, is this a liquidity crisis? Are you out of money?
That's the crypto market PTSD talking.
It is. But management was very firm. They said this is purely a technical fix, a software bug, not a liquidity crisis. The pipes got clogged, the reservoir was full, and they say it's been resolved.
It's a good reminder that even with all this everything exchange stuff, the core tech has to work 100% of the time.
Absolutely. But in the grand scheme of the story they're telling, it's likely just a blip.
So let's bring this all together. If you're listening to this, trying to make sense of it all, what is the one big takeaway?
I think the big takeaway is that Coinbase is trying to graduate. They're graduating from being a crypto casino, where you got to gamble on dog coins, to being the actual financial infrastructure of the future.
And they have the cash, $11 billion of it, to weather any volatility.
And they have the strategy. By integrating everything, they're ensuring that no matter what you want to trade, you do it with them. And by building Base, they're positioning themselves so that when the AI economy really takes off, it runs on their rails.
It's a bold play. 2026 is definitely the proving ground.
It is. Their GAAP profitability is still at the mercy of crypto prices because of those accounting rules. But the operating engine, it's stronger than it has ever been.
I can't stop thinking about that AI agent thing. It really changes how you view the future of all this.
It raises a really provocative question, doesn't it?
What's the...
Well, if AI agents begin to hold their own wallets and they start spending their own money on the blockchain to execute tasks, are we looking at a future where the primary users of the global financial system aren't humans at all?
That is both exciting and slightly terrifying all at once.
It means economic activity could happen at a speed and a scale we can't even comprehend. The GDP of the internet might eventually eclipse the GDP of the physical world.
Well, on that note, I think I need to go check my portfolio and maybe ask my AI assistant if it needs an allowance.
Just make sure you pay it in USDC.
Obviously. Thanks for listening to The Deep Dive, everyone. We'll catch you next time.